Good afternoon, dear traders. In previous webinars, we discussed very important things, such as general Dow theory, support and resistance levels, market noise, market participants, trading system, mathematics, statistics, and news. We also considered a very important stage in becoming trader. These are entry points. All of these topics are great and provide a good basis for becoming a trader. Of course, a lot remains ahead for you. And above all, it is with experience to learn how to read the chart, look for the best opportunities, feel the energy of the instrument, understand the nature of the move. So, the entry point is definitely very important, but it is no less important to maintain a position which should correspond to the general principles of your trading system, the mathematics of the trading system, the instrument's volatility, and its nature of the move. I would advise you to decompose the entry mechanism and entire mechanism of maintaining a position into several stages and to make it clear to you. I will show you with examples on charts. So, first chart. Please look at my screen. So, first, even before opening a position, you must assess the volatility of the instrument, how much it passes on average per day. That is, the ATR or standard deviation indicators will help you with this. I perceive it visually, but at first I would recommend taking ATR for 21 trading days. And you see here at the chart, if ATR will move up, volatility is expanding. The market is ready for moves above the average. And if volatility flows near this line, the market is prone to noisy intraday movements, to lower volatility. It's actually for S&P 500 or Nasdaq VIX. So, look at the VIX volatility index. If the VIX is heading and is inclined to move up, then you can count on more significant potential in the current day. If down, then the volatility is reduced. The instrument is likely to trade noisily and will not go far. And very important moment. Here, the volatility is good for intraday trading, but when the volatility is low, it's good for investment ideas and stock portfolio management. Okay, next picture. For example, in this case, the ATR was decreasing. The volatility in the last few days has also dropped, and I understood that if we take the potential, it will be limited. Roughly, according to the chart, it is good if the instrument can reach 3,520. So here. According to the entry point, this is an example from real trading. The entry point is not bad, but it would be even stronger, closer to the level of 3,540.17. So, better here with limit order to sell. But I thought and evaluated for a long time. This also happens. But it is important not to catch up with the price. The entry is appropriate as long as you are satisfied with the estimated potential relative to the stop. In this case, the estimated potential relative to volatility is up to 3,520. Next picture. Second step. After you have assessed the potential and identified an approximate goal, now your task is to competently accompany the position. In this case, the take profit is set below 3,520, and I would be ready to move even lower. This is done in case of a strong impulse falls in the S&P 500, like it was here or here. So, what can you do on the way to the goal when you have already passed some part of the position? Secure the position. Move the stop to break even. But beginners and even professionals very often make one and the same mistake: a hasty transfer of a stop loss order to break even. Allegedly, it becomes too calm in the soul. It is interesting that when this transfer of the stop to break even in the event of a return to the entry point does not change anything in terms of the scenario. That is, opening a position, a trader seems to say, okay, I'm ready for this risk. And imagine, suddenly, in a few minutes, as soon as position is opened, he begins to doubt his decision. Compared to sports, I like comparison with sports, It reminds me a tennis player with a good serve, but uncertain for the accompaniment of the game. If you field for elimination, then the point is yours. In trading, if a powerful and irrecoverable impulse immediately followed just a landslide fall, as it was first time from 3,540, like this, then the trader earned his profit without any doubts. But count now, often a tennis player kicked through. Most innings are still played out, every game, every set. And if the player's skills are weak, then the tennis player will be defeated. Also for the trader, the instrument falls vertically in a few cases. It's about 1 or 2% from all movement. So positioning skills are very important. In this picture, you can see that the instrument breaks through 3,533. Consolidation, impulse, and breakthrough. And before that, there was a rollback to the 3,537 area. Impulse, correction, impulse. That is, in the event of a buyout, the scenario will already have obvious problems, and it becomes uninteresting. So, if it will be buyout, it's not so interesting. It's noise. It's not enough active pressure. Therefore, the stop loss order moves to break even in this very logic, and not because it is safer to live this way, because it's a good reason. It's understandable reason here. You see, stop loss here. Chart 5. The third step is to fix the position. Fixing a position must satisfy, first of all, the mathematics of the trading system. Please remember our webinar on trading system mathematics. Okay. But nevertheless, let's return to the block of mathematics for consolidation. Let's say you have 30% positive trades. Here. That is, out of 10 deals, you close 3 deals with a plus. In this case, to count the commissions and swaps, it's necessary to take a minimum 4-to-1 profit in relation to the risk. You see. To satisfy annual return more than banking percent. Okay, if you systematically violate your own mathematics, then the deposit will obviously move in the wrong direction. So let's go back to the chart with fixation. Here the first goal is that the mathematics of the trading system is already satisfied. The instrument has gone 5-to-1 profit in relation to the risk. By the nature of the movement, there are no shear sales, as was the case from 3,540 earlier. The average volatility of the instrument has been passed, and with each tick, the probability of rebound increases, and the instrument reacts to 3,520. You see. My reaction starts, and the profit is fixed. Next picture 7. It's Europe. Another example for consolidation. What can happen if you leave with only one hold? This is a pair of euro to dollar. Mirror holding with a false breakout of the level 1.21 and 1. 1.21 and 1. You see mirror level and false breakout. It was important here that consolidation does not lead to a breakout and the instrument is held back even at 1.21135 here. Further sluggish purchases from 1.21102. You see, sluggish purchases, not active buyout. Okay. And this is also an important signal in terms of the nature of the move. Selling as soon as the first trail of active selling appears and the stop relative to volatility is quite adequate. So you see, first active selling pressure here. Before that, we looked at the mini chart. That is, opening a position was according to the mini chart, of course taking into account the external picture. Now we are tracing the position not only locally, but also from the position of the 50-minute chart. Remember, the time frame is just scaling. Technically, after the breakdown of 1.2895, it seems that the way to 1.2743 is open and we can relax. So, very active pressure, breakdown of 1.2895 level, and it seems that the way into 1.2743 is open. But locally, a technically important detail is that after the breakdown of 1.2847 with a fairly strong consolidation, it does not fly down on the impulse. You see, consolidation, false breakout, another pressure, breakdown of 1.2847, and here I expecting strong move into 1.2743. It does not happen. So that is, something is clearly not happening according to the nature of the move. A decision must be made. So the math at the point of return about 1.2847 is already more than 4-to-1 risk reward. I had doubts about the nature of the move here, so fixing 5-to-1 profit to risk. And this is what a lack of concentration in intraday trading or a relaxed attitude towards trading can lead to. Extreme concentration, timely exit. Further, the instrument would have already hit the stop at break-even, and if there was no break-even, then a minus would be received on the deal. Okay, I hope you enjoyed this webinar. It will be helpful for you. In the next webinars, we will also analyze more than one example. You always visually understand much better the logic of decision making and the logic of conducting and implementing a transaction. It is not for nothing that they say that it is better to see once than hear 100 times. So all the best for you and see you soon.